My name is Andy White. Excuse me. And tonight's topic I'd like to talk about is the S&P 500 and which way it's going. And in particular, I believe it's going to 5,000 by the end of 2021. It's just 8 months away. We only hit 4,000 back in March. Whenever you talk about a topic like this, it inevitably invites the question of bubbles. Many people much larger than myself have said we're in a bubble and it's going to end disastrously. They may be right, or they may be wrong. It's what makes a market. I believe we are not in a bubble. We are currently overvalued, but we are not in a bubble. And indeed, we have about 20% upside to the end of the year. Now, how do I come to such a position? Well, I use an old tool that doesn't seem to be used much on Wall Street, regression. It's a little untraditional to use in equity markets, but last year when the market dropped, 35%, and the economy started slowing down, traditional valuation methods did not help at all. So my colleague and I from Alpha Growth Capital worked on a regression model that would predict the level of the S&P 500 without the need for earnings estimates. We found the way. That formed an article which is available on my LinkedIn site if you want to go and visit. It's called S&P 500 4,000 by the end of the year 2020. As I mentioned, we were right about the level, we were wrong about the time. It came 3 months after the end of 2020, but I'm still happy about it. As we approached the anniversary, so to speak, of the 4,000 call, I began thinking about writing a follow-up article. And the more I analyzed the model and updated it, the more I realized that there could be a call for 5,000 by the end of 2021. And that's what I'd like to talk to you about this evening. There is no bubble. What do you hear out there? Fear for your lives. Worst bubble in history, save tulip mania. Nope, not at all. This time is different, really. Now, I know what you're thinking when you hear that. Listen to my reason. Why is it different this time? Unprecedented and importantly, unvalued federal support, which is ongoing. You'll see how that plays in a moment. Perhaps it's easier to see what I'm talking about from a long-term point of view. I put a chart on this slide that's not necessarily related to the presentation, but it does give you an idea just how bubbly we are or are not. This is a logarithmic S&P 500 price chart from 1960 to the present. That's a pretty defined channel. We are not even halfway up that channel currently. Does that mean we're going to shoot to the sky tomorrow? Probably not, but it means the next couple of years may not be as disastrous as people think. Let's get into the nitty-gritty though. Regression. Before we do that, I need to give you a little statistical regression primer for those that may have studied it in college but not since. First and foremost, statistical regression is regression analysis as a set of statistical processes for estimating the relationships between a dependent variable, a data series like S&P 500, and one or more independent variables or factors. I suspect everyone's clear as mud on that right now. Put another way, regression is regressing one or more factors against a data series like the S&P 500 to find out which factors actually cause the S&P 500 to go up or down. Also, two little points about statistics. There's lies, damn lies, and then there's statistics. Take everything with a grain of salt. I've tried to be as objective as possible with the creation of this model and as straightforward with you as I can be. But there's always a possibility out there that I've missed something or that somebody else might have an agenda. I like to say that I don't. Correlation also does not necessarily mean causation. Many times people think that just because two things are related to each other, that one must cause the other. There's a very famous stock market indicator called the Super Bowl indicator, in which whether the NFC or the AFC team wins the Super Bowl, you should invest in the stock market or not. Those are correlated, but I wouldn't recommend investing on that basis. So with that done, and I was sorry about having to do that, let's move into the actual model. We looked at a variety of different indicators and we settled on 4 factors: gross domestic product, or GDP, money supply, or M2, that's cash and cash equivalents, corporate bond spread, which is the high yield bond minus the constant 10-year treasury bond rate, and the CPI. So 4 factors: GDP, M2, corporate bond spread, and CPI. Notice that those are all economic or market generated factors. There are no fundamental estimates necessary in this model. For example, earnings is not to be seen. As I mentioned, in early 2020, reliable earnings estimates weren't even available. We had to find another way. It worked and kept us sane through 2020, and it seems to be keeping us profitable through 2021. The result of regressing these 5 factors against the S&P 500 resulted in a 95% R squared. For those unfamiliar with that, that means that this model explains 95% of the ups and the downs in the S&P 500. That's pretty good and something that's worth studying. The factors correlate very nicely. They have the appropriate coefficient signs, i.e. you would expect that gross domestic product would be positively influencing the S&P 500, it does, whereas CPI negatively influences the S&P 500, and it does. Most importantly, this model has high statistical significance. For those that know it, that means each factor has a 0 p-value and the entire model has a 0 f-factor. That basically means that this model is not a coincidence. So let's look at that a little more graphically. If you were to run the regression and then plot the predicted line that comes out of it, this is what it looks like, 1960 to the present day. It certainly looks like a bubble, but the human mind has difficulty processing effectively hyperbolic growth rates. Is it actually a bubble? Well, let's get a little bit deeper into it. The red line on the chart is the actual S&P 500. The blue line is the model predicted S&P 500. And you can see they pattern each other pretty darn close. That's that 95% R squared I mentioned. In addition, we have calculated a proxy for standard deviation of 3 standard deviations above the predicted line and 3 standard deviations below the predicted line, which basically means that 99% of the observations for the S&P 500 are included within those 2 bands. Another way of looking at it, as long as you're within those 3, the plus or minus 3 standard deviation bands, you're probably okay. You might get a little overvalued or a little undervalued, but it's not a bubble or a disaster. And to put things in perspective, there's only really one notable true bubble in the last, well, 60 years or so. Now, there are some smaller ones, but the big one you probably know very well, latter 1990s. As you can see, it bounces right out of the standard deviation bands and way above the predicted value. Well, we all know what was going on then, but what was the actual level at its high during the latter 90s bull market? It reached 15 standard deviations above the predicted value. That's a bubble. 3, not so much. Now, what you can do with regressions historically, you can also do in the future and figure out what you believe will be the level of the S&P 500 at any given time in the future. For example, the end of 2021. You have to have assumptions, though, for those 4 factors, which are reasonably easy to come to. We can all disagree on them, and I'd be happy to discuss how I reached these numbers, but these are the numbers I use for the end of 2021. These are my current assumptions. GDP growth rate of nominal growth rate of 7.5%. M2 rising from 19 trillion in December 2020 to 22.5 trillion. A lot of federal and Federal Reserve spending. Corporate bond spread of 2%, which is pretty much where it is right now. And a consumer price index up 3.5%. There's only so much you can push into an economy before a supply constraints result in inflation. That's a GDP of 7.5%, an M2 of 22.5 trillion, corporate bond spread of 2%, and a CPI of 3.5%. You plug that into the regression model. You are forecasting what the predicted value for the S&P 500 will be in 8 months' time, the end of the year. We close on April 19th at 4,163 on the S&P. The fair value calculated by the model is 3,700. So we're clearly trading over the model predicted value. But how much are we trading? We're trading 2.5 standard deviations above fair value. That means it's overvalued. It's a little pricey. So perhaps a short-term correction is possible, and we might be seeing the beginning of it this week. But that's no bubble. If you remember, it has to be over 3 standard deviations to get me the least bit concerned. And if you remember that in the height of the 90s bubble, it was as high as 15 times. Now, I'm not saying we're going to go to that, but nevertheless, there's a big difference between overvalued and bubble. I'm going to leave this up here for just one more moment so that you can take in the numbers, because there's going to be more numbers, and I apologize for that, but there's just no way around it with a regression discussion. One last point I'll make is that 3 standard deviations above fair value with these assumptions is 4,300 on the S&P, which is 3% above. Well, after today, it's 4% above where we currently are. So that's not much of an outlook for the year, but it's still 4%. A lot of people would take that. Now, what happens if my assumptions are a little too conservative? Let's say that the federal government decides to push through the infrastructure bill and is successful. And let's say that the little rumored 4th stimulus bill comes to fruition. In that case, we have a more aggressive assumption for the end of the year 2020 factor assumptions. GDP will be a mind-warping 9.5% nominal growth. Half of that is CPI up 5%. M2 will rise to 24.5 trillion, and the corporate bond spread will probably go down to 1.5% because the good times are certainly rolling. What the long-term cost is a different story, but the short term, it's a party. With those 4 factors assumptions, a little more aggressive than the first one, based on that April 19th close, we are trading 1 standard deviation above fair value of 4,000, not 3,600 with the other assumptions. 1 standard deviation is even better than 2.5 standard deviations. It's getting better, not worse as a bubble. This is not a bubble. For perspective, 3 standard deviations on these assumptions above fair value would be 4,600, which is about 10 or 11% above where we are today. It's still not a bubble. In fact, it's getting better. Depends on your assumptions. I'll leave this up here for a moment. Now, the interesting thing is, when we get out to the end of 2021, markets forecast into the future. They're not going to care about 2021 assumptions or reality by that point. They're going to be looking at 2022 and discounting it back to the present day, which would be the end of this year. These are my assumptions for the end of year 2020, discounted back to 2021 end of the year. GDP in the year 2022 is 5% nominal growth rate. So a significant deceleration in the GDP growth rate. It's a short-term pumping of the financial markets at the cost of future growth. M2 would rise to 27 trillion. No additional federal government support is necessary for that. The growth of the economy and the Federal Reserve's $120 billion a month repurchase program will continue, and that would result in 27 trillion M2. Corporate bond spread is starting to return to normal as the economy starts to return to normal at 2.5%. That could be a little low, but it's going in the right direction. And CPI drops to 3%. With these 4 assumptions for 2022 discounted back to the end of this year, fair value of the model is 4,150. That is also where we're trading at 4,163. We are trading at fair value of the 2022 assumptions discounted back to the end of this year. What happens if the market actually has more of a party and does what it's tended to do over the last year and a half, a bull market? What if it trades up to 3 standard deviations of fair value based on these assumptions? The fair value would be 4,008. The 3 standard deviations above fair value would be 4,800, or 15% above where we are today. What if it traded as far as 4 standard deviations, which is at best a small bubble, probably just a month or 2 above 3 standard deviations? It still get to my price target though. And if you're wondering if 4 standard deviations is just out of the ordinary, it's not. It's happened 4 times in the last year. It all depends on how excited the market wants to become. So that's how you get to 5,000 S&P 500 by the end of this year. You did not have to use earnings estimates. All you needed to do was use relatively easy to determine economic factors. So I believe that the S&P 500 is going to 5,000 by the end of year 2021. That gives us a 20% upside. Untraditional times call for untraditional yet proven regression valuation model. 4 regression factors: GDP, M2, corporate bond spread, and the CPI. So I don't know about you, but I intend to climb that wall of worry. Vaccines, reopenings, inflation, taxes, regulations, sentiment, and even technicals. If they give me the opportunity, I'm going to buy it. So thank you very much. I guess we'll open the floor to questions.
Okay, well, that was a lot of information. And during the time that you were speaking, Andrew, we did receive a number of questions. So I'm going to go to the first question, I believe, and I'll call on you. And when I call on you, if you get a chance, you can just, if you're open, you can just unmute yourself and you can ask the question if you'd like. The first one was from Michael Murray. Asking how did the model perform in ex-post forecasts? Michael, you want to ask your question live here?
Sure. Ex-post forecasting is leaving off some of the most recent data, fitting the model using the training data that remains. And the question is, when that's done, how well did the model predict recent points? Some other questions about the model are, and I apologize, I was a couple of minutes late, but I'm not sure how the model was actually fit. Was GDP put in, for example, as a dollar amount, or was it put in as a percent change? Same questions for M2 and the CPI.
Those are good questions, Michael. Thank you for asking them. The best example I can give for the ex post was that the original model was created back in about April or May of 2020, and it was written up around June, and it called for 4,000 on the S&P 500 by the end of the year. Excuse me. So by definition, that would be entirely ex post from June to the end of the year. Now, it did not get to 4,000 by the end of December. It actually got there by the end of March of this year. So I would say it hit the number, just didn't hit the time period. In terms of your second question, the fitting here is GDP was used dollar amount nominal. M2 is dollar amount. Corporate bond spread is a percent. And CPI is a percent. I'm sorry, CPI is actually the level, not the percent.
Wouldn't there be an issue with correlation between series like GDP measured in dollars, the CPI and M2, because all of them have been trending up over time, as has the S&P 500.
You're talking about correlation between them?
Yes.
Is this based on the fact that some are dollars and some are percent?
No, I think you said that GDP was used as a dollar variable when fitting the model, that the CPI was used also as a level as opposed to a percent change, and that M2 was put in as a dollar value as opposed to a percent change. Mm-hmm. And all three of those series have been rising over time. So there's a kind of a multi-collinearity question, isn't there?
There could be. I have to admit I don't have a good answer for that because I did not check for correlation between the factors.
That's thank you, Michael. Thank you for your questions. This brings up perhaps a good segue to Gus Guliev's question, which is related to CPI and M2. Gus, do you want to ask your question, or do you feel it got answered?
Well, thank you so much, Andre, for the presentation. And obviously, Michael raised quite a good questions on the correlation between the CPI, GDP, and M2. So yes, thank you.
Okay, thank you, Gus. Next question is from Chris Testa. Chris, come on down. Are you available, Chris?
Yes, I am. Can you hear me, Doug?
Yes.
Okay, great. Thanks for the presentation, Doug, for hosting, and Andrew for presenting. Very interesting model. I used to spend a lot of time in leverage credit, and I found it interesting that you're using high yield spreads in general, given that it's a fairly small subset of the equity universe. So I guess I'm curious as to why you didn't use the investment grade index. And I'm also kind of puzzled by just the actual number, because I know high yield yields are about 4% right now, and spreads are like 299 or something. You know, the average duration in high yields probably, you know, maybe 5 or so years, maybe even a little less. But it's not quite the duration of a 10-year. So just kind of curious about some of those things.
Okay, I didn't catch the second question. Can you repeat it?
Yeah, I mean, just simplify, just why not investment grade spreads? And then just mechanically, I didn't understand your calculation for the corporate bond spread, because you had 200 when I would have thought it'd be 300.
That's an interesting point. On the corporate bond spread, that was the number that we recorded. That's why I used it. If it's incorrect, that will mean that the model will be overestimated. But I'll have to go back and verify that. In terms of why did we not use investment grade, we wanted to have something that was riskier, because the stock market tends to be more risky than it does an investment grade investment. So it's a risk factor. It's
Great.
not meant to be a credit
Understood.
factor.
Thank
It's
you.
meant to be a risk factor.
Thanks so much.
Thank you.
Thank you for asking the question. Well, let's we've heard enough from the guys. Let's bring on the ladies. Marlene Birnbaum. Are you available to ask your question in regards to median forecast?
Yes, it seems to me that a lot of economists are saying that the 2022 GDP is being pulled into this year, 2021. And so they're thinking that GDP would go back to like historic rates. I mean, it was even 2%, but I kind of put in what I thought was trend line of 3%. So I just wondered if you would speak to that as to how you are not thinking that 2022, when you don't have any more monetary stimulus and diminished Fed stimulus, that the GDP will remain as high as your forecast.
It's a good point. Were you talking about real GDP or nominal GDP?
Well, let's see, I guess I was talking about nominal.
Nominal at 2%? It's typically GDP is quoted in real terms in the press.
Okay, well then, okay, so sorry, say real terms, 2.5 to 3%.
Well, then we're actually in agreement.
Okay.
The 5% I use for 2022 is actually a 2% real and a 3% CPI, which will bring you to 5%. So we're actually in agreement.
Okay, thank you.
Thank you.
Thank you, Marlene. And let's see, let's keep going. And please, I see lots of folks have put their LinkedIn information in the chat. I encourage you to do this, and do remember that you can save the chat at the end of this presentation by clicking the 3 buttons in the chat feature. It's on the bottom right. And there's a question here. It looks like we're going back to Michael Murray related to Marlene. Michael, you want to ask your question related to Marlene?
Andrew answered the question perfectly.
Terrific. Okay, thank you, Michael. I have another question here, which is, this is for you, Andrew. How do the traditional valuation measures revert to eventually agree with your regression-based model?
Well, it's a good question. How do you look at a PE ratio, and however you want to define it, on a chart, and imagine that it's ever going to get back to a normal valuation, let alone one that I'm calling not a bubble? How do they revert to each other? Well, this one can continue to go up. By that I mean the regression model. It won't go up as much as time goes by because we are starting from overvalued level. But nevertheless, it can continue to go up. So that's one way. The other way is what happens to the P and what happens to the E in the traditional valuation model. Well, the E is going to shoot straight up in the short term due to monetary stimulus, in the longer term due to just more historical economic growth rates, and that M2 number, that's cash sitting in bank accounts. And slowly but surely it will leak out into the economy. So we might actually have an upside surprise, certainly if not on GDP, on the earnings side. So that's one way it can revert. The denominator can go up much faster than expected. In terms of the price side, well, it can go up. That wouldn't be helpful for reverting the models to each other. It could go down. That wouldn't be helpful to anybody's pocketbook. So we kind of hope that won't happen. I suspect it will go sideways with a slight upward tilt. In doing so, the price side basically goes flat and the earnings side goes up. Therefore, excuse me, the valuation models start coming into the same orbit. That answer your question?
That was great, but I have a follow-up to that question, which is, regression's a fairly simple technique, you know, for some. Couldn't anyone really do this?
Absolutely. That's what I love it so much about it. I don't believe that there's an ivory castle in Wall Street that's going to come down and give us the right price for the stock market. I think each and every one of us can come up with our own expectations. Anyone with an Excel spreadsheet, access to the internet, to go to Fred, which is where you get the data, and knows how to use the statistics package, which is simply an equation or a process for regression, can create this entire spreadsheet for this entire analysis. I like that, kind of a democratization of Wall Street, if you will.
No, thank you for that question. And while you answer that, a post came up from one of the attendees saying how she helps keep people out of jail with her compliance skills. Sorry, it just caught my eye as I read that. It just made me chuckle. I do have some more questions for you. Your model doesn't include fundamental data. How can that outperform traditional equity investing, which is earnings focused?
Well, all I can say is that it is actually doing it, at least ever since we started creating it and monitoring it. I'm amazed by it myself. I, like everybody, have been trained to focus on earnings and issues surrounding earnings. I'm not saying that's a bad idea. I'm simply saying that PE ratio has no effective way to factor in trillions of dollars of federal government and Federal Reserve spending. It's just not there. So therefore, it could very well vary from the historical averages and yet not be as overvalued as you might think. That's the reason for the search for and the use of the regression model. I would also say that the S&P 500 is what we're talking about here, not a single stock where earnings would be more important. S&P 500 is designed to imperfectly mirror the US economy. Therefore, economic factors could theoretically be valid for predicting the future levels of the S&P 500.
I have another follow-up question. What happens if they end up less than 3 standard deviations from fair value?
Two things. One, the model will not reach 5,000 by the end of year 2021. Yes, in the year 2021. And the other thing is I'll lose my bet with my friend in Switzerland and I'll owe him a very nice bottle of wine.
Okay. feel free to continue to place questions in the chat. Michael Murray, you want to ask your question again? Or make your point, rather?
Well, there was a question a moment ago about fundamentals. And it feels like GDP growth and the CPI are proxies for corporate profits. So in some sense, fundamentals are built into the model, but I'm still stuck on the fact that the model was fit to the level of the S&P 500 using the level of GDP and CPI and M2. And I was wondering if there'd been an attempt to fit the model to actually using the growth rates in those series. There's a lot more movement in growth rates, percent changes, than there is in levels.
It's a good insight. We did not, is the answer. We chose to go with the levels.
Well, it'd be interesting if you did. I'd love to see that. It's since you've already got all the data, it seems like an easy transformation to do.
Well, if you want to be in touch after this, I can run those numbers and we can see how it works out.
It'd be intriguing.
Okay. All right, great questions, Michael. Another question for you, Andrew. And you're doing great in answering these questions. Really appreciate it. Thank you for being so thorough. How do you determine your 2021 and 2022 factor estimates?
Good question. 2021 was basically based upon current estimates in the market. Now we can disagree on the exact levels, but I'd like to believe that I've gotten pretty close to them. Then you have the 2021 more aggressive estimates, which are basically the infrastructure package and the possibility of a fourth stimulus package coming down the route by maybe summer or fall. That's how you get to the more aggressive estimates. And in 2022, I wanted to see a lower economic growth rate because, as I believe it was Marlene said, we're pulling economic growth from the future using our gigantic credit card. So 5% seemed to be an appropriate level and close to historical averages. The difference being CPI is going to be higher than standard averages, so that the growth rate on a real basis will actually be about 2%. That's pretty anemic. As well, I saw the corporate bond spread rising as the economy became more normalized and less focused on COVID. And I think I mentioned inflation. Yes, I did. Well, one last point, M2. How did M2 get up another, I think, $1 or $1.5 trillion? Well, part of that is the Fed's repurchasing program eventually tapering off. And part of that is the normal growth of an economy. M2 naturally grows.
Okay, thank you. We have a question from Henry NG. Henry, are you available to ask your question?
Yes. Quick question is, those factors, GDP, M2, corporate bond spread, and CPI, what percent weighting of each does each one contribute?
Equal weighting.
Equal weight?
Yes.
I see. Thank you.
My pleasure.
In these factors,
another side question. What is the intuition of those factors?
The intuition?
Yeah.
If by that you mean, why did I choose those factors?
Yeah. How would those factors help predict the S&P directions?
Well, theoretical support for those is, as Michael would probably agree, is GDP is a proxy for growth. M2 is a proxy for potential growth. The credit bond spread is a proxy for risk in the market. And the CPI is also an indirect risk function for inflation.
I see. Thank you.
Thank you.
are you factoring in any indicator or factors that's happening, what may be happening in the rest of the world? For example, like action taken by European central banks or some banks, central banks in Asia, for example?
Am I using international data?
Right.
Probably, it's an interesting idea because there are a lot of multinationals in the S&P, but I did not do that, no.
We've had a number of people join the presentation a little late, but thank you for joining nevertheless. So I just want to reiterate that this is the FANGS SIG Special Interest Group Asset Management, Banking and Insurance Chapter presentation. We have folks from across the country here. We do this every month, and we've been having the pleasure of listening to Andrew White, CFA. So thank you for joining and continuing. And for those that have been on the call from the beginning, thank you very much. I have another question here for you, Andrew, which is, what would make investors bid stocks up to 4 standard deviations over fair value?
Whatever creates overvaluation in history of the stock market is excitement and greed. It happens over and over and over again. In fact, in the last year, we've had 4 instances in which the standard deviation of the trading at the time was between 3 and 4 times the fair value at the time. So it is very precedented. It doesn't take much to go from 3 to 4. It doesn't stay at 4 very long, though, unless it goes into a real bubble, which is a devil's handshake.
Well, I have a personal question for you as I wait for more questions to come in.
Mm-hmm.
Do you have any opinion to share on what's happening with the cryptocurrency phenomenon right now? And should people invest or stay weary of this entire sector? You know, is it about to explode or in a negative way, or do you think this is the wave of the future?
Well, I see, by the way, that's a loaded question, but I appreciate it. I see Bitcoin and the altcoins as the biggest startup ever. It doesn't generate profit, or rather earnings. It has no effective valuation, though, just like in the dot-com era. People are coming up with ways to value it based on network size. I'm not saying any of those are incorrect, and there certainly is a lot of correlation with them. But basically, it's the Wild West. Always has been and will be for a long time, though it is slowing down over time. I actually wrote an article on that, Bitcoin himself, where I compared him to a high school, college student, and as he matured, what would happen. It was interesting. To get to your more pointed question, should we invest in it now? Well, I can only give you my own example. In my own fund, we do invest in Bitcoin and other cryptos. And we took money off the table last Thursday, I think, or was it Friday? Part of that was that we got hit a little bit in the post-Turkey banning of Bitcoin, which also makes people wonder about, will India go through and ban Bitcoin? How about China with their new digital currency for the country? Regulatory risk is always been there, but it's increasing in size. Governments tend to like to control things, and they can't control Bitcoin very easily. And governments are not known for being nimble. So they may go out and ban it outright. And that would be an Armageddon scenario, because everybody holding Bitcoin would have no way of disposing of it. It would go to zero. Now, that's a worst case scenario, and it would happen over a long period of time. But it was enough to make us start to look at our portfolio diversification. How much can we afford to lose should the worst happen? And I think that's a good way to invest. Make sure you have stop losses. I believe in the project long term. Invest, be exposed, have your stop losses, and implement them. Don't get caught up in the fervor of gigantic returns. Stick to your discipline, and you'll probably do okay.
Thank you. Really appreciate that. I know it's a little off topic, but I appreciate your insight. There is a question from James Easterlin regarding projected PE. James, you want to ask your question?
Yeah, the question is, you go through, I understand PE doesn't go into the model, but if you run your model to get to the 5,000 beyond in 2022, what is the implied PE for 2022 from once you run your model?
Andrew, I'm not sure if you heard that, but it was a little tough to hear, James, but I believe your question is, what is projected PE for 2022?
That's correct, yeah.
I don't use PE anymore, so I don't have a good answer for you. I apologize. Maybe Matt, was it Madeline? Maybe she knows. She seems to have her finger on that pulse.
I wasn't asking, I know you don't use it, but if you go your calculation and then look back, what is the PE as a result of your other calculations?
I see what you mean. Well, it's 5,000 if we reach it on the S&P 500. I just need to know what the earnings component is. And I'm not following that, amazingly enough. A stock investor doesn't follow earnings. I apologize, I can't give you a definitive answer.
Okay.
But thank you, James. Thank you for asking your question. Brings us back to Michael Murray. Michael, you have a lengthy question here in regards to models and indices and components. Go ahead, Michael, ask your question, please.
Well, first, I don't want to risk dominating this conversation. Are you sure you don't want to take a question from somebody else?
No, you're doing great, Michael. Thank you so much. Appreciate that.
Well, I was just going to ask Andrew if he tried fitting the same model to other indexes like the Russell or the Dow or the NASDAQ, or even just some components of the S&P 500 like the S&P utilities or financials. And I guess sort of related to this, I was kind of curious about Andrew's thoughts about how the increasing concentration of the S&P 500 and just a handful of stocks, Facebook, Apple, Netflix, Google, Amazon, maybe Tesla. You know, you might have 5 or 6 stocks that are 80% of the S&P 500 these days. Any thoughts about that?
Well, excellent insights. That'd be fascinating to fit the model to other indices. The factors may have to be adjusted or changed because they'll be more specific to parts of the economy. But that would make for an interesting extension to this project. Thank you. In terms of concentration, that is a huge risk to the model, because if the S&P 500 becomes, let's say, an untenable situation of, let's say, 5 stocks are 95% of the market, which is never going to happen. But if it did, then you'd be better off forecasting those 5 stocks than you would a model that's looking at the broad economy. Currently, I think the top 10 are like 50% of the market, something along those lines. It will have an influence. How much of an influence, I do not know. But thus far, in real time, it's been an effective model. Not sticking with it.
Andy, thank you for sharing your model. It's elegant in its simplicity. I was just wondering, I recognize that you were probably an equities guy, but just wondering if you had thought about some type of similar model for fixed income markets. For example, maybe projecting direction of spreads, corporate spreads.
Corporate spread. As a factor, you mean?
No, in a separate model, developing another model that maybe would help to predict corporate spreads.
That's an interesting idea too. I love this. I didn't realize I might be setting up a business here. But these are great ideas. If you want, please be in touch and we can talk more about how to develop something like that.
Thank you.
Thank you.
Just to let everyone know, as the host of this presentation, I take 10% of all new businesses created from this call. So thank you very much. My attorneys will be in touch. Now, this is great. This is what FANG is about. It's about networking. It's about making relationships. It's about bringing in talented speakers like Andrew. Thank you for asking all these terrific questions, and Andrew for having answers. Stefan Maris-Vari, you were making a point, top 6 or 25%. Do you want to elaborate on that?
I mean, yeah, so there was a number thrown out, the 80% or something like that. I mean, you can look if you look at the holdings of SPY, which is the S&P 500 market cap weighted ETF, I think the top 6 holdings are around 25% after Tesla got included. So it's not as concentrated as many people think. But that's something definitely to consider, right? Concentration risk, I think, comes into play.
Absolutely.
Yeah.
But you're saying there's room for it to grow.
I was wondering, and I may have missed it because I had to drop off for a few minutes in between, but did you talk about, so I guess we're talking here mainly about equity valuations, but I was thinking, how does the interest rate environment play here into this with regard to looking? It seems like we saw quite some movement on the 30-year. And how do you think about that if that environment starts moving a bit with inflation expectations, stuff like that?
Are you asking my opinion about where yields are going?
Yeah, and how that would maybe influence your goal here with the 5,000s.
Well, the only influence on the model that rising interest rates would have is whether or not it impacts, how it impacts rather the high yield market, because it's the high yield minus the constant 10-year treasury rate. So that if the treasury bond, rallies, or not rallies, but falls through the floor and yields go through the roof, high yield presumably would go through the roof too. What I'm interested in is the difference between those. If high yield actually rallies, thus its yields compress, while the treasury bond yields are going up, that's very bullish for the model, because that's saying that risk is actually declining. I'm not saying that that's consistent, but I'm saying, giving you an example of how it would impact the model. If the treasury bond rate was increasing and the high yield rate was increasing faster, that would negatively impact the model, and thus the S&P forecast would be reduced. What we're seeing thus far is the first example. Treasury yields have risen, high yields have actually compressed, particularly in the last week.
Thanks, very insightful.
Do you have a follow-up question, Stefan?
I'm not sure. Did we talk about crypto at some point? Is this at all something you consider with all these valuations? I mean, it seems to be a lot of money being assembled in cryptos, and does this make you think about? You said there's no bubble, maybe not in equities, maybe there are other bubbles in the market.
I didn't follow the question. I'm sorry.
So I was asking about cryptocurrencies, right? Bitcoin, for example, now valued at 1 trillion. I saw Dogecoin or whatever it is, 50 billion. I mean, there's a lot of money in these, let's call them alternative assets for now. And do you have any thoughts on that? And does this play here a role with equities?
Well, that might come down to risk tolerance. I mean, basically everything is off the benchmark of the Bitcoin. It's amazing to think of it that way, but Bitcoin's your blue chip in crypto world. Everything else is more volatile. For example, Bitcoin was down 2% today, and I believe Ether was down about 5% or more. Of course, it works on the other side too. When Bitcoin rises, the other coins, what's called altcoins, tend to rise even more. So it really comes down to your risk appetite. Now, I'm bullish on Bitcoin because it's more established. And I believe that the other coins, well, they're a little too risky for my blood. But it really depends on which waters you want to surf in.
Thanks, Andrew.
Thank you, Stefan. I have a question here from, or maybe not a question, but a statement regards to estimates from William Bachelor. William, would you like to take the light?
I'll give it a shot. I just was looking up what the estimates were for 21, 22, and the forward 12 months. Usually we look at these things on a sort of a rolling forward 12-month basis. But it, it would fit in with, I think it fits pretty well with the model that you put together and where your estimates are coming out.
Thank you.
And thank you for sharing this with us. And Doug, thank you for organizing it.
No, you're welcome. Thank you for participating. Again, it's the members of FANG that make this, truly, an interactive and successful event. Let's see. Michael Murray, looks like you have a follow-up question in regards to yields and spreads. You want to ask your question here?
Well, it wasn't so much a question. Somebody asked Andrew a while ago about the implications of changes in yields or spreads. And Andrew addressed that eloquently, but given that there's also GDP and M2 and the CPI in the model, if you change your assumption about yields or spreads, it might also make sense to rethink the assumptions about GDP and the CPI and the like, because, well, the economy is like one big system of simultaneous equations and everything is kind of jointly or simultaneously determined. And if you move one piece, you might be moving the other pieces at the same time.
That's absolutely true.
Thank you, Michael. Scott Russo, yes, we have time for your question regards to margin debt. Scott, you want to jump on?
Yeah, thanks so much for the presentation. It's fantastic. I missed the first few minutes, so apologies. This might have been covered. But does the model take into effect the large increase in margin debt that's been out there in terms of leverage, and obviously the whole Archegos incident in terms of the undermining of that hedge fund and what it could do if we have a pretty substantial correction?
Not explicitly, no. The model defaults on these issues to buying opportunities, if you will. Margin debt goes high, margin debt goes low. Sentiment goes bullish, sentiment goes bearish. And the idea is, as long as you know where your end goal is, it doesn't really much matter what the trajectory is. If margin takes a dip because people are worried about the market going down, and indeed it results in the market going down, that's a huge good news to me. I walk in and I buy it because they just gave me the opportunity. In other words, it's called buy on the dip, which I hate to say. I've never been a buy on the dipper, but with this model, I have the confidence to sleep safely at night, or calmly at night, I should say, not safely. And that's what I see as terms of margin or sentiment or technical analysis. These are the waves on the otherwise ocean.
Got it. I missed the beginning. So when you say in your title slide, bubble overvalued, now underlined, are we saying like 10 to 20% overvalued or less than that? It's
about 13% overvalued right now, according to the regression model.
Got it. Okay.
After today, that's probably 12.
If it's the Russell, maybe 11, but yeah, I hear you.
Depends on which part of it you're in.
Thank you for that. That's very helpful. Thank you again for your time and great presentation.
Thank you, Scott.
Okay, keep it coming. And any more questions? We've had tremendous participation tonight. This has been terrific. Sometimes our presenters speak for 90% of the time, and we have 10% opportunity for Q&A. This has been the inverse of that, and it's incredible how the questions have been coming and the dialogue. So, any further questions at this time? Well, Andrew, do you have any? If there are no further questions, Andrew, do you have any final comments that you'd like to finish this presentation off with?
Sure. If you take anything away from this presentation, please take away that there is no bubble yet. That doesn't mean there couldn't be one, but you can sleep safer at night based on the analysis that I have done. If you want to know more about it, I'm happy to talk to anybody who wants to contact me. My details are at the beginning of the chat side on this presentation. I don't know what to call that. Please ring me up and we'll talk about it. Thank you for your time and for your questions.
And thank you, everyone. And again, my name is Doug Zucker. I'm the banking SIG chair. We have 3 groups here with us tonight, the insurance, asset management, and banking SIG groups. And for those that have stayed on the call, you have the privilege of hearing the upcoming speakers. And one of them, which is our May speaker, came about because Joyce from Fang reached out to me and said, one of our members is interested in BNPL. And I said, what? And she said, buy now, pay later. I said, oh, like buying a mattress or furniture in a store. And she said, well, it's a little more than that, and sent me an article from Forbes magazine. And I reached out to the author of the article from Forbes, got in touch with her, had a dialogue, and Melody Brew, senior analyst of More Insights and Strategy, and the author of the Forbes article on BNPL, will be our presenter for the month of May. In June, we will have James Francis, and James is actually one of our FENG members. So as I mentioned earlier, please, if you're interested in speaking, reach out to me. There is so much talent in FENG that don't hold it to yourself. Take that opportunity to speak. It can add to terrific networking opportunities for you. And James Francis is from New York. He's the CEO of Paradigm Asset Management. And James will be speaking in June. Our intention at this point is to take off the months of July and August, and we'll work on September. September, we'll get back to you during the summer and let you know what'll take place then. So we're set for the next 2 months. And Andrew, this was fantastic, really, really great, exceeded expectations. Of course, I mentioned earlier too, please click on the 3 dots in your message chat, and you can save the dialogue, the chat dialogue. You can download it to your computer. If you haven't already, add your LinkedIn to the chat or any other contact information. Mine is there, Andrew's is there, including the presentation. If you go to the very beginning of the chat, you'll see Andrew's presentation. And I believe that's a wrap. So thank you very much to everyone.